Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you for giving us a few minutes of your time here this first week of November, where I'm usually not one for small talk and commenting on the weather, but I must do so, at least here in central Indiana. Andrew, I'm sure you'll agree it's just spectacular to have some sun and some low 70s, and hopefully have a little bit of a nice little second autumn maybe.
Yeah, it's been great.
Yeah. Moving along to finance, got 3 points for you. First, we're going to talk about wealth effect and maybe the other side of that and what that means. We'll get to in just a second. And then Andrew's got a couple of technical points as always. So diving right into reverse wealth effect. And before I get into the table, I'll just give you some background. And to best describe the background, we start with actually what is the wealth effect. The wealth effect was a significant piece of the Federal Reserve strategy on the upside, starting with Bernanke back in 2009. Part of what they tried to achieve was stimulating asset prices. Yes, the stock market, but real estate and everything as well. And with lifting asset prices, perhaps a wealthier American consumer would spend more and continue to heal the economy. So to some degree, that probably worked. But now we are on the other side of that, and they are trying to break the backs of inflation. And part of that is engineering a reverse wealth effect. They have even spoken to the need to have asset prices, or at least I should say certain voting members have even spoken to the need for asset prices to come down. So to that extent, we have a reverse wealth effect, trying to keep asset prices limited to cool things and hopefully have that to contribute to the cooling of inflation. So here we have on this table several instances going back to 1972 where the Wilshire 5000 declined by 20% or more. That is the percent loss column. The average of those declines, by the way, is 32.1%. That is your average, call it severe drawdown period. However, we do have a discrepancy or a difference in terms of how much it impacted the total level of the economy. And that stems because we have different starting points. And what's unique about this one is that the stock market, the Wilshire 5000, its value was substantial. It was really large relative to the economy. So it has made a pretty sizable dent in terms of its decline as a percentage of GDP. If you go back to the top arrow there at 1980 to 1982, the last time we really had to hammer home and break inflation, 28.3% drop in the market only created a 14% drop as wealth as a percentage of GDP. So what all that meant was that at that point in time, because the stock market was already relatively depressed after a decade of really lagging behind throughout the 1970s, the Federal Reserve, Volcker, in those days had to raise interest rates. He only had that as a tool to really hammer home inflation. So the hope here is that the wealth effect actually works in our favor, and this 26.8% can do a lot of the heavy lifting. The jury will certainly be out on this, but it is something that the Federal Reserve watches and may be a factor that causes them to perhaps slow down and pause just a little bit sooner than we expected. We'll find out more about this as the Federal Reserve releases this meeting here in November, and then perhaps some updated guidance on what they will do with interest rates going forward. Now, Andrew, you shared with us some positive news and some notes with fund flows. I'll let you start off with those.
Very good. So we spend a lot of time in the Market Carver, and in our allocation meetings each week, we talk about breadth. We talked about, I think we've talked about it last week on the Market Carver, the percent of stocks that are participating in either an equity rally or equity decline. We often focus on how individual stocks or how indices are doing, but something else we also want to track and keep our eye on is ETFs. Each year we see ETFs become a much bigger part of the conversation when we talk about portfolios. They're very much a big part of the conversation when we're talking about your portfolios. We use ETFs every day as we build out our models. A piece of information we can gain from these exchange-traded funds is the flows in and out of them, the money that's coming into them as people buy them, or the money flowing out of them as investors sell them. So one of the largest ETFs is SPY. S&P tracks the S&P 500. It's billions and billions and billions of dollars in assets, one of the largest out there. And so this is a good one for us to keep an eye on, because as investors start to get more bullish on the market, we typically, at least we should be, seeing inflows into ETFs like this. We can also track it for bonds. We can track it for different sectors. But right now, we're just going to look at SPY. And so the chart here, we have the ETF on the top part. We have a 3-month rolling net flows in the middle. So as that indicator turns green, that means we're seeing more money going in over the last 3 months than out. And in the bottom, we just have the daily change. What we want to focus on right now is that middle part, that 3-month flow. So you can see since 2022, it's been a lot of time in the red as money was flowing out of SPY as investors were selling. And then when we'd have these counter trend rallies, when the market would start to strengthen, we would start seeing a little bit of an increase in fund flows back into this ETF. So the bullishness, what we're seeing today is we're actually seeing more money flowing in to SPY than we did on the last time. We've seen at least what turned out to be just counter trend rallies, short periods of market rising higher that then eventually reverse lower. So the fact that we're seeing more interest in owning this passive S&P 500 ETF is a positive sign that maybe we are seeing a shift in sentiment to where investors, both professional, retail, your 401k, investors like us when we're managing your assets, are starting to show stronger interest in getting more exposure to equities. That's a great sign. It's not enough alone to say whether you're bullish or bearish, but it's a good sign to see more money flowing in to a very, very large ETF. And we'll see if that continues through the rest of the year, or if we start seeing outflows come out, then maybe that's a sign that sentiment has shifted once again and investors start to head for the exits. But right now, it's looking like a good sign at this point.
Yeah, hey, it's the same way on the downside. It didn't come all at once. There were several small signs that built up. So through an optimistic lens, we'll hope that they continue to build. If they don't, we're here to deal with it and manage it. But we'll take the encouraging signs. One more factor, and that's just the importance of sectors play in our portfolio and just how significant they've been so far in 2022. And just to remind the audience here and to let them know on the work that you do, part of what Handy does is very in-depth, really I would call academic research into sectors. And so he's developed a methodology for us that is very unique. It is actually very scientific and very complex, but it's also been very helpful and one of the key things for us in 2022. So Andrew, I'll let you kind of show just how important it's been when you just look at the dispersion of sectors.
Yeah, so sectors are something we talk about all week long on our investment team. And every month we reevaluate our sector rotation to determine what sectors we want to have the most exposure to within the portfolios. For a lot of this year, we haven't seen a big change. And knock on wood, it's been thankful that a lot of that exposure has been towards the energy sector. And we've seen other sectors come in and show some strength, and we'll make adjustments as we need to see fit. But energy really has been a dominating sector this year. And we can really see that on this next chart I wanted to show you. And this comes from Standard & Poor's and shows going back to the 1990s, it shows the difference in performance for the best sector versus the worst sector. And so you're always going to have, every year we'll have some sectors that do really well and some that don't do great. But there hasn't been a year like this year to where the best has been so much better than the worst. The best sector this year so far through October has been energy, of course, and then the worst has actually been communications. A large chunk of that is Facebook, makes up a big part of the communications sector. XLC is the ticker symbol for that. And what we've found is that when we look back in history, that if you're able to find what those strong sectors are, and able to get kind of attach your wagon to those sectors and be able to participate in some of their strength, that's how we can try to get asset appreciation within the portfolios. And this year has very much been a very wide spread between what's done really well and what's not done very well at all. In fact, like I said, we haven't seen this wide of a spread going back to the 90s. The last time they got this close was in 2000, when technology stocks were really being put under pressure as the dot-com bubble started to implode, and we started seeing tech really start to sell off. And that was one of the lower performing sectors at that time. And we're seeing something now with energy outperforming and communications underperforming. Really shows the significance and importance of understanding the sectors and understanding where strength is showing up in the market. And currently it's been energy. Will that continue? We continue to look to the data and to make that determination. But so far, energy has been a great sector, and we're thankful to have had our sector model have some good exposure there throughout 2022. And we'll see if that continues and make adjustments as the data changes.
Excellently done, and hit your wagon. Great terminology. Certainly speaks to our roots here. So appreciate that. Just a reminder to you all, if we haven't had the pleasure of working with you, please give us a call. We'd be happy to sit down and have a no obligations meeting with you, at least no commitment needed on your part. Just give us a call, 800-928-4001. And as always, we're just so appreciative of you giving us a few minutes of your time, and hopefully you have a great weekend.